Namaste. We have completed preparing financial statements of a company. Now, we shall be going for the next level, analysis of financial statements. This is supposed to be a part of management accounting. You know why? When I am going to give you a balance sheet, you will look at the balance sheet and you can say, okay, fine, this company's plant and machinery is so and so, intangible asset is so and so, long-term borrowings are so and so. That's all. It will be a mere figure, that's all, a numerical presentation, that's all. But that cannot give you an idea as to how the funds were generated for the purchase of the asset, what was the position in the previous year, what is the position during the current year, whether there is an improvement in the performance of the organization or the organization remains to be the same from what it was before. There cannot be any inference drawn by financial statements. So, it is not going to give you a clear picture, for that matter for anybody. And when a layman looks at it, for him it looks like one presentation, that's all. So, as finance people, we need to now go for a critical analysis of the financial statements to draw inferences. So, what is the purpose of analysis of financial statement? Mere financial statement cannot give clarity about the changes that have taken place in the financial position of the organization over a period of time. So, a critical analysis of the changes that have taken place in the financial statement is called as analysis of financial statements. Analysis of financial statements can be done in the following ways. There are very many tools for analysis of financial statements, namely comparative financial statements, common size financial statements, ratio analysis, cash flow statement and trend analysis. Now, what is the purpose of these analysis of financial statements? I told you already, a mere financial statement presentation cannot give any conclusion, cannot have any clarity. So, to critically evaluate the performance of the organization, we need to analyze the relative performance of the organization over a period of time or between other companies also. Say for example, we need to analyze the performance of tire industry. So, suppose we take JK Tires for example. JK Tires performance of the previous year with the current year or the 4 years before that and the current year can be done, or JK Tires performance with similar other industries like Dunlop Tires, CI Tires, etc., by which we can draw inference which company is doing good, which company's performance is better than the other companies, etc. So that it will be very beneficial for the management to take a decision, for the investors to take a decision, for the government to observe the functioning of the particular industry. Of course, it has its own limitations like that of any other analysis of financial statement. Like any financial statement is basically dependent on the financial statement. So, any analysis will be effective only when the financial statement is correct. If the financial statement is misled, obviously the result of analysis also will be misleading only. Analysis of financial statement is done on the records which are already prepared. That means they are historical in nature. So, it's only a mere post-mortem of what has already happened. These are all the criticisms that are there before the analysis of financial statements. But still, definitely the merits of analysis of financial statements are far more than the limitations of analysis of financial statements. So, we are going to go in detail about the main two tools called comparative financial statements and common size financial statements. We will also be discussing about accounting, ratios and cash flow statement. Trend analysis you would have come across in the cricket matches where you find the trend that is being shown, the team playing first after 5 overs, what is the run rate, what is the after 10 overs, what is the current run rate and the projected score. If it's going to be a 20-20 match, at the end of 20 overs, what will be the trend? The present rate, projected rate like 5 runs per over, 7 runs per over, 9 runs per over, they show the predictions, projections, fine, and they make an analysis. then the team playing second. They make a comparative analysis between the team played first. After 5 overs, what was the performance of the team played first and what is the performance of the current team. So, for the viewer, it will be very clear, very easy to compare whether the team playing second is going at par or ahead of the team played first to know about the success rate. So, that is what is called as trend analysis. So, that can be represented in a graphical manner also, in the form of a graph or in the form of a pie chart or in the form of a bar diagram. It can be expressed very clearly by using 2 different colors or 2 different shapes. Comparison can be easily done. Accounting ratios is the critical examination of relationship between 2 variables of a financial statement. So it is basically numerical in nature, expressing between the numbers, expressing the relationship between 2 variables. Cash flow statement is a statement prepared to analyze the relative inflows and outflows of cash and cash equivalents due to operating, investing and financing activities. Now, let us complete our knowledge, our learning by knowing about comparative financial statements and common size financial statements. What do you mean by comparative financial statements? When the results of an organization are compared with its own results of the past or with similar industry for a particular period of time, it is called as comparative financial statement. So, the results of the current year will be compared with the results of the previous year. The absolute change will be found out and the particular absolute change will be expressed as a percentage, which is called as comparative financial statement. So, it can be done even on a quarterly basis like Q1, Q2 analysis, Q2, Q3 analysis, Q3, Q4 analysis, Q4 and Q1 of the subsequent year analysis or Q4 of the previous year with Q1 of the current year analysis can be done. And expressing the change in terms of percentage is called as comparative financial statement and it is also called as horizontal analysis. So, company X, company Y, performance of the current year, say for example year ending 31st March 2021. Performance of X Limited with performance of Y Limited to draw conclusion which company is doing better than the other. In that case, keeping X as a constant, expressing the results of Y as a base to X and drawing inferences or the other way around is also possible. Similarly, comparing the results of 2021 with 2020, 2019, 2018, 2017, 5 years analysis can be done, 10 years analysis can be done. Population studies, statistics about population are all coming under this comparative analysis only. So, they are called as horizontal analysis. What is the purpose of comparative financial statement? Comparative financial statements are prepared to analyze the performance of an organization with its own past figures or with similar industries to know what is the change that has taken place and whether the change is in the positive side or on the flip side. And the format of comparative financial statements we shall discuss now. Let me complete common size financial statements also. What are common size financial statements? Common size financial statements, otherwise called as vertical analysis. Common size financial statements are prepared to draw an idea about the composition of each of the item in the financial statement to a common base. So, what portion of total sales is spent towards cost of production? What percentage of the total sales is spent for finance cost? What percentage of the total income goes for other expenses? To know and to have a control, effective control over the expenses, common size financial statements are prepared. Similarly, common size balance sheet is prepared to know the composition of each of the element of balance sheet to the total of the balance sheet which is taken as a common base. So, in common size financial statement, we call it as vertical analysis, so that we will be able to know the composition and contribution of each of the item to a common base. Now, we shall be now learning about the format of comparative financial statements and common size financial statements. So, the format of comparative financial statement, whether it is income statement or position statement, the format remains to be the same. In the particulars column, you will represent the given information, either income statement or position statement, in that particular order. So, income statement will start with revenue from operations and other income. You will get total income. Then you will go for total expenses. In that, you will have cost of revenue from operations, other expenses. The figure will give you profit before tax. From that, you will subtract tax percentage that has been given. You will arrive at profit after interest and tax. This is the format of income statement. The same format will you be writing it. Then, in case if you are given note number, you will write the note number. Then, information that is given about the previous year, you will write here. Information that is given about the current year, you will write here. Find out the difference between the two. So, A, B, C. What is D? D is nothing but C minus B. Then you will find out absolute percentage of change. How will you find out percentage of change? Percentage of change is nothing but as absolute change divided by base year into 100 will give you the percentage of change. Please remember, from board point of view, up to 2 decimals should you simplify. Up to 2 decimals should you simplify. So, this is the format of comparative financial statements. While comparative financial statements make a comparison between the current year and the previous year, or organization X with organization Y, common size financial statement is going to make a comparative analysis between the figures. That's all, between the information to a common base. Therefore, we will have the format of year percentage, or company percentage. So, the format will be particulars, note number, base year. In that, you will write the amount, percentage. Similarly, current year, in that again you are going to divide it as amount, percentage. This can also be company X, company Y. Company X amount percentage, company Y amount percentage, and the total, in case of income statement, the total revenue from operations will be taken as 100%. In case of balance sheet, total of the balance sheet will be taken as 100%. So, this is the format of comparative financial statements and common size financial statements. Now, we shall work out few problems on comparative balance sheet and comparative income statement, then common size balance sheet and common size income statement. Now, the first example that I have given is comparative balance sheet of Grow More Limited as of 31st March 2020 and 31st March 2021. So, the base year is 31st March 2020, the year ending 31st March 2020 is the base year, upon which we are going to compare the performance of the results of the year 2021, the year ending 31st March 2021. Now, share capital, base year information is 2 lakhs, current year information is 3 lakhs. So, there is an increase of 1 lakh. So, the percentage of increase will be 50%. So, how are we going to calculate percentage of change? Percentage of change is calculated by dividing absolute change by base year into 100. So the same we are following here. So absolute change by base year into 100 gives you 50%. The second item, reserves and surplus. Current year 2 lakhs, base year also 2 lakhs. So there is no change, absolute change also nil. The third one, long-term borrowings. Base year is 40,000. Current year is 1,60,000. That means it has multiplied thrice. So 1,20,000 rupees increase, which is 300% increase. 300% increase. Then trade payables. Base year is 60,000 rupees. Current year is 1 lakh. So there is an increase of 40,000 rupees to 2/3 increase, which is 66.67%. Now, total of the balance sheet. Base year is 5 lakh rupees. Current year is 7,60,000 rupees. So there is an increase to the extent of 2,60,000 rupees, which is leading to a percentage of increase of 52. There is an increase to the extent of 52%. Now coming to next one, non-current assets. Fixed asset, opening balance is 3,60,000, closing balance is 5,60,000. There is an increase to the extent of 2 lakhs, giving an increase of 55.56%. The non-current investment, opening balance 40,000, closing balance 40,000, no increase or no decrease, therefore there is no difference in percentage of change also. Coming to current assets, opening balance of trade receivables is 80,000 rupees, closing balance of trade receivable is 1,20,000 rupees. There is an increase to the extent of 40,000 rupees, so leading to an increase of 50%. The next, cash and cash equivalents, 20,000 opening balance, 40,000 closing balance. There is an increase to the extent of 20,000 rupees. So increase to the extent of 100%. So total of the balance sheet, opening balance 5 lakh, closing balance 7,60,000, increase to the extent of 2,60,000. So percentage of change is 52%. So having prepared a comparative balance sheet, now the students can make inferences. Now we can clearly say that share capital has increased by 50%. Correspondingly, you find net fixed asset is increasing by 55.56%. That means investment in non-current asset would have been funded by share capital and any other source. That way we can infer any number of analysis by seeing the comparative balance sheet. The next one we are going to see is about comparative income statement. So, we are going to prepare the comparative statement of profit and loss of Sun Track Limited. So, you are given the question that revenue from operations base year is 12 lakh rupees, current year is 20 lakh rupees. So, there is an increase of 8 lakh rupees. So, 8 lakh divided by 12 lakh into 100 will give you 66.67%. The next one, other income. Other income, base year is 9 lakh rupees, current year is 12 lakh rupees. So, there is an increase to the extent of 3 lakh rupees. So, 3 lakh divided by 9 lakh into 100 gives you 33.33%. So, the total gives you 21 lakh is the total income. Total income for the current year is 32 lakhs. There is an increase to the extent of 11 lakhs, which gives you the percentage of 52.38%. Coming to next one, less expenses. Expenses, base year is 10 lakh, current year is 13 lakh. There is an increase to the tune of 3 lakh rupees, giving to a percentage of 13. Now, profit before tax, 21 lakh minus 10 lakh gives you 11 lakh for the base year. 32 lakhs minus 13 lakhs gives you 19 lakhs for the current year, leading to an increase of 8 lakhs. So, 8 lakh divided by 11 lakh into 100 gives you 72.73%. Now, in this question, you are not given the tax percentage. So, we are ending the problem with this. But let's assume there is a tax of 50%. Less tax at 50%. Assume. that there is a tax at the rate of 50% for both current year and the base year, then the tax amount will be 5,50,000 for the base year, 9,50,000 for the current year, leading to an increase of 4 lakh rupees, and the percentage will remain to be the same at 72.73%. So now profit after tax will be the remaining 50%, which is 5,50,000, 9,50,000, 4 lakh is a difference, leading to a percentage of increase of 72.73%. So we have calculated the percentage of increase or decrease for the revenue from operations, then other income, then total income. From the total income, we subtracted the expenses. We got the profit before tax. We assumed the tax rate to be 50%. We have calculated tax and we have calculated profit after tax also. This is the format of comparative statement of profit and loss. Next, we shall be proceeding to common size financial statements. So now we are going to try a common size balance sheet. Now you are given information of Sun Limited for 2 years, 2020-2021. Please remember, common size financial statements are vertical analysis. So we are going to compare the information given to a common base of the same year. So there is no comparison between base year and current year, etc. Current year's information is going to be compared with its own common base. So 2020 total of the balance sheet is 1 crore, which is taken as 100%. Now, every item of the liability side and every item of asset side will be compared to the common base. So, proportion of share capital to the total of the balance sheet. So, 60 lakh is the total of share capital. Expressed as a percentage to a common base, you get 60%. 8 lakh to a common base of 1 crore gives you 8%. 20 lakh to the common base of 1 crore gives you 20%. 12 lakhs to a common base of 1 crore gives you 12%. So if you add all these things, that gives you 100%. 60% plus 8% plus 20% plus 12% gives you 100%. Now coming to the asset side of the current year, asset side of the base year. So we take it as 2020 asset side. 60 lakh is the total of tangible fixed asset. Expressed as a percentage to the common base, you get 60%. That means 60% of the total balance sheet is consisting of tangible fixed assets. Then intangible fixed asset is 12 lakh to a common base of 1 crore gives you 12%. Inventory is 20 lakh expressed to the common base gives you 20%. Similarly, cash and cash equivalents are 8 lakh to the common base of 1 crore, which gives you 8%. So, 60 plus 12 plus 20 plus 8 gives you 100%. So, we have finished for the year 2020. Now, for the year 2021, the total of the balance sheet is 1 crore 20 lakh. We are going to express every item of the balance sheet to the common base, which is 1 crore 20 lakhs. So 80 lakh divided by 1 crore 20 lakhs gives you 66.67%. 12 lakh to a common base of 1 crore 20 lakhs gives you 10%. 24 lakhs to a common base of 1 crore 20 lakhs will be giving you 20%. Then 4 lakh to the common base of 1 crore 20 lakhs gives you 3.33%. The total of it comes to 100%. Now, the next one is 80 lakh to a common base of 1 crore 20 lakhs again gives you 66.67%. Then 4 lakh to 1 crore 20 lakhs gives you 3.33%. Then 24 lakhs to 1 crore 20 lakhs gives you 20%. And 12 lakhs to 1 crore 20 lakhs gives you 10%. So the total of the balance sheet is taken as 100%. So we can say that total fixed asset for the current year constitute 66.67% of the total of the balance sheet. Non-current asset constitute 3.33% of the total of the balance sheet. That way for inventories and cash equivalents. This is how we will be preparing the common size balance sheet. These are all 3-mark chapter weighted in the board examination with the choice question. The choice may be between comparative and common size income statement or comparative income statement with common size balance sheet or vice versa. So now we are going to see the next one, common size income statement. So I have taken a common size income statement. The information given are for the years 2020 and 2021. Now in 2020, revenue from operations is 7,50,000 rupees, which we are taking as 100%. With that, we are adding other income of 75,000 rupees, which is 10% to the total, is 10%. So 7,50,000 to 75,000 is 10%. The total comes to total revenue for the organization is 8,25,000, which is 110%. So 8,25,000 divided by 7,50,000 into 100 will give you 110%. Now we are going to find out the proportion of each of the expense to the total revenue from operations. So purchase of stock in trade is 6 lakh rupees. 6 lakh divided by 7,50,000 into 100 gives you 80%. The next, change in inventories 10,000 rupees to 7,50,000 rupees gives you 1.33%. Other expenses are 7,500 to 7,50,000 rupees gives you 1%. So the total expenses are 6,17,500, which if we compare with 7,50,000 rupees, this constitutes 82.33%. Coming to profit before tax, income minus expense, total revenue minus total expenses, you get 2,07,500, which is going to be 27.67%. Then you are going to deduct income tax, which is given 50%. So 1,03,750. 1,03,750 to 7,50,000 rupees gives you 13.83%. Obviously, the remaining also is 13.83%. Now coming to the current year, that is 2021, 10 lakh is the total revenue from operations, which is assumed to be 100%. Then other revenue is 1 lakh, which is 10%. Total revenue is going to be 110%, which is 11 lakh. Now coming to expenses, 7,50,000 is the purchase of stock in trade, which gives you 75%. Then change in inventory. Change in inventory is nothing but closing stock minus opening stock. So now you find an unfavorable 50,000 rupees, which is an unfavorable 5%. Then other expenses constitute 10,000 rupees to a common base of 10 lakh rupees gives you 1%. So now this is going to be the total 11 lakhs minus 7,10,000 rupees. That gives you 71%. 71%. Then profit before tax is 3,90,000. 3,90,000 to a common base gives you 39%. So 7,10,000 to 10 lakh gives you 71%. 3,90,000 to 10 lakh gives you 39%. Then income tax is 50%. 1,95,000 rupees, which is going to be 19.5%. And the remaining 19.5% will be your profit after tax. So this is how we prepare common size income statement. So common size income statement, we are making a comparison of the current year with its own results. So to a common base. So we took revenue from operations to be 100% and expressed every item of income statement to the common base. This is how we will be preparing common size statement of profit and loss. So, we have completed two important tools of financial statements, namely comparative financial statements and common size financial statements. Namaste.